So Daniel, thanks very much indeed for joining us today from Madrid, where you're still in kind of quasi lockdown. I really appreciate it. First of all, let's start with one of your big focuses, and that is debt. And maybe we'll focus a wee bit more on tech and the recovery and all of that separately. But let's think first of all about the debt that our nation states are getting themselves into. What do you think are going to be the major ramifications in terms of the global economy, in terms of the continuance of the debt-led so-called recovery?
One of the things that we're hearing constantly these days is that debt doesn't matter. That as long as interest rates are low, that as long as there's ample liquidity and central banks continue to pump money, it is no problem if governments pile up on debt and if deficits continue to soar. But it's a completely false narrative. The reality is that debt matters, and it matters a lot. Debt means less productivity growth. Debt means less growth in itself, less employment as well, and a worsening outlook for households, because either through inflation or through taxation, which both are the same, but either through higher inflation or through higher taxes in the future, it is literally eating out of the savings of citizens in the future. The problem is that governments seem very comfortable with the current situation. They believe that no problem exists. They don't see a rising inflation, even though we do see, for example, that protests due to the increase of cost of living are increasing all over the world. And the fact that they are generating massive inflation in financial assets, fundamentally in sovereign debt. But the reality is that it's very likely that they will pursue their policy to the extreme. They have seen that you can go to 200, 250% debt to GDP, as we have seen, for example, in Japan. And it is very, very likely that we will see something of that sort in a few years.
And they're using a lot of the central banks and governments are using the excuse that in these unprecedented times and with low interest rates, they can kind of afford to inject all of this liquidity into the market, and that it'll be okay in the end. Do you not believe them?
Well, I certainly don't. To start with, because for central banks and for governments, every environment is an unprecedented one. We have lived many years of growth and no risk, no crisis, and governments continue to increase deficits while central banks increase liquidity and lowered rates. So it's a perverse incentive, and it's a false narrative again. The idea that you need to inject liquidity into the economy and that governments need to solve the situation by massively increasing debt it sounds very, well, obviously comes from the neo-Keynesian book, but in reality, what it only shows is that governments, what they're doing is generating more disincentives for productivity growth. And therefore, what ends up happening is that every year is in quote unquote unprecedented year for them. It doesn't matter when in 2018, 2019, because growth was subdued, because there were risks due to the trade war, because there were risks. There's always risks. The idea that governments need to offset every risk in the economy is ludicrous. But the idea that monetary policy is going to be normalized when things get better is proven to be wrong. They just accelerate.
But we have this double whammy effect, of, as you say, the huge asset purchasing programs and the bailouts, the huge increases in sovereign debt. But at the same time, the urge to revive the economies that have been decimated by certain sectors being shut down effectively during the COVID-19 crisis. How is this going to pan out? Are we going to see any redemption at all?
Well, there will be some level of recovery. But if there's anything that we've learned out of this crisis is that the idea that shutting down an entire economy, even for a couple of months, would have no ramifications and would have no significant implications in the longer term was something that only a bureaucrat could believe. It's ridiculous, no? So we have a very interesting situation. On the one side, all of the problems that the economy is facing right now come from the unilateral decision of governments of shutting down the economy entirely. Economies in which governments have handled better the pandemic and have not destroyed the economy through shutdowns are doing quite well, are doing all right. There's obviously a few challenges and they're not growing as expected. But if you look at South Korea, you look at Singapore, you look at Taiwan, you look at Austria, you look at Switzerland, these are economies that are going to have a very, very mild recession. So it's interesting that governments tell us that a problem created by government, which is, oh, what a great idea would it be to shut down an economy entirely and see what happens, should be solved by more government intervention, when the only thing that they needed to do was to reopen and to handle healthcare and handle a health crisis with a little bit more prudence.
Now, there's a few governments that are saying, well, the road out of this disaster, really, this economic disaster, is with tech. You know, the tech is going to come to the salvation. That technology will fix it all for us. But of course, with the as you rightly mentioned, the increase in debt and the focus on corporate asset purchase rather than, for example, venture capital, do you see that there's going to be also a consequence for early stage technology companies that traditionally have to get venture capital funding? Are the VCs hanging on to their cash?
There is a big risk of losing in the most important parts of the economy due to the massive bailouts. Because what governments are doing and what central banks are doing is literally bailing out the companies that actually could survive pretty well. The corporate bond purchases of central banks are aimed fundamentally at very large companies that already had access to the debt market and that had access to cheap debt anyhow. So it is interesting that this bailout of everything is at the same time pushing forward and delaying and even eliminating some of the innovation, startup business, technology, artificial intelligence, and other important aspects of the capital expenditure programs of companies. And as you very well mentioned, another problem is likely to be that venture capital that led the innovation process in the past 5 to 7 years with an incredible rise in funds devoted to new ventures. This venture capital is likely to be a lot more prudent because in many of the investments that they have pushed forward in the last years, there's likely to be a need to hold on to cash and a need to be more, let's say, conservative. So interestingly enough, this idea of the bailout of everything, in which governments decide that everything that is already working right now needs to receive some form of direct or indirect subsidy, is actually delaying or eliminating very, very important areas of the innovation investment.
Yeah, because one of our partner organizations for this event is Spain AI. You know, the Spanish AI community is huge. It's vibrant. But, you know, one of the key messages that I got when I spoke to the chair of the Spanish AI organization was that, you know, there is this crunch. You have lots and lots of interesting little companies doing interesting things, often spin-outs from companies that have established as a result of foreign direct investment. But one, FDI is kind of in stalemate at the minute. And two, there is a much less availability of venture capital. So it is having a disproportionate impact, isn't it, on SMEs?
Absolutely. Absolutely. It's interesting because if we think about what is a solid and sustainable recovery, it usually comes from the rapid development of small companies into large companies and the innovation process that creates new businesses. And those two things, the move from small and medium enterprise to large company and the creation of new businesses, are the two areas that this massive stimulus and huge bailout programs that are being implemented by governments are not addressing. In fact, if anything, when governments decide to put billions of public money to support, I wouldn't call them dinosaurs, but definitely mature companies that already were large, that were already having problems in the past years because they were not growing and they were already in a sort of latter part of their existence. And they put trillions of dollars into these companies. You're basically just subsidizing the past to destroy the future. And you're squeezing out the credit environment for innovation. You're squeezing out the creation of new businesses, and you're basically perpetuating those large companies that in some countries work as some sort of hidden social security that were already in trouble in the past. Think about, for example, the Eurozone. You look at all of the massive amounts of subsidies and corporate programs that have been implemented. Where are they going to? They're going to airlines, they're going to the auto sector, they're going to refineries, they're going to steel mills. But where is the money that should be now invested in new technology, in new ways and better technology to work with citizens, in improving healthcare services? All of that is being pushed aside.
Yeah, and one of the consequences as well of the current situation is that I've seen a huge amount of increase in interest within the startup community in technologies underpinned by blockchain. And you and I have had many conversations about blockchain in the past, but this seems to be the event, the global class event that is causing blockchain to suddenly come into play, because blockchain affords the opportunity to disrupt existing markets, existing supply chains, whatever. So, and existing financial systems. Do you think that the whole blockchain crypto thing is going to come massively into play again?
Oh, definitely it will. I think it will. And we're seeing, for example, that in terms of the concerns about the monetary aspect of the massive central bank action we're seeing right now, specifically in emerging markets, you're seeing how there's a massive increase also in funds and in investment coming from the hedge funds and from the more innovative type of investors that are looking at that part of the economy as the next phase of improvement. So if we think of anything that has to do with blockchain and everything that has to do with digital currencies, there's been an incredible surge in funding. Is it enough? Well, obviously not compared to the trillions of dollars that we were mentioning before to bail out the pre-existing businesses and the sectors that already were in some form of slowdown. But it is rising, and considering what is happening, we're living in a very interesting environment. We're living in an environment in which everybody, for example, is talking about the weakness of the dollar, which is actually coinciding with a much larger weakness of emerging market currencies. So that in one side is making investments into Bitcoin and into alternative currencies soar, and investments into blockchain and everything that can help in disruptive technologies also improve and grow significantly, helped to a certain extent by the...
Yeah, I was just going to ask you on that. The Swedish government has announced that it's investigating the creation of an e-krona, essentially built on blockchain. You know, so I think there seems to be a dawning that if we have ZIRP and NIRP, or NIRP and ZIRP, and you know, a devaluation of currency really as a result of sovereign debt, that really there needs to be safe haven, and even it would appear that the central banks are beginning to try to muscle in on the act by turning their own currencies into virtual currencies. Which is interesting, isn't it? Because think about it, a central bank promoted cryptocurrency is an oxymoron, is a contradiction. Yeah. Makes absolutely no sense. But I think that what they're finding is that fiat currencies in a new world in which we live a constant increase in money supply, and in which central banks compete against each other to combat the effects of increased liquidity and lower rates, this NIRP and SIRP environment that you were mentioning, obviously central banks are going to try to implement their own cryptocurrencies or their own e-currencies. To a certain extent, the US dollar is the prevailing e-currency, but it's not going to be what drives, in my opinion, the change and the disruption. I think that what we are seeing is that the lack of trust in many fiat currencies is accelerating dramatically. Yeah. We are looking from the Euro area to the UK to the United States with people that more or less enjoy or established currencies with a certain level of strength. However, as we speak, the Brazilians are seeing their currency depreciated by 20%. The Argentinians are seeing their currency depreciate by 17%. The Turkish are seeing their currency depreciate by another 17% to already all-time lows. The destruction of trust in fiat currencies all over the world is massive. We just don't realize it because we either work with relatively stable currencies like the euro, the pound, or the US dollar, or because our position as investors allows us to offset the impact of devaluation through financial assets. But it is impressive to see how many currencies so far this year are down between 20 to 30% relative to the US dollar. And what is that going to be the breaking point, that we do actually see currencies break? You know, that we are going to see the sovereign crises increasingly in terms of and potential bailouts, certainly in the Eurozone, maybe not the Eurozone, but let me ask the question, what's going to be the breaking point for NIRP and ZIRP? Well, I think that we're already seeing the first part of the breaking point. The first part of the breaking point is that emerging markets are unable to finance themselves in local currency. Therefore, they have to increase their debt in US dollars in order to get some financing, because neither local domestic investors or international investors want currency risk. So that is the first part, and that is happening in emerging economies. What is likely to drive the next phase would be if
the reserve currency status of either the euro or the US dollar would be put in question. Because right now, the entire system is predicated on the basis that, yes, there's a significant fluctuation and weakness in the vast majority of currencies globally, but there are two dominant currencies that maintain everything alive: the euro and the US dollar. Actually, in a different order. First the US dollar, then the euro. If by any chance the euro was to break up, or the US dollar was to reduce its situation as reserve currency, then you would see that that I would say, collapse of the system as we know it. Collapse doesn't mean a disaster in the economy. Means that the idea that you can continuously increase debt because that deficit that is building that debt might create some support from other saving countries just breaks up. No? Right now, the entire system is predicated on the basis that the deficits of the stable currency nations are financed with the savings of the non-stable currency nations. And that the central banks of the emerging economies or non-stable currency nations need to buy reserves, i.e. debt, of the US or the Eurozone. That might change very quickly. And obviously, that's where alternative measures and alternative currencies start to play an important role.
So what's your prognosis in terms of the recovery, in terms of Western economies anyway? You know, we're seeing, well, the United Kingdom, certainly a number of the European economies, you know, getting into serious difficulties. America potentially having, wrestling with a really, really difficult problem as far as COVID is concerned, and escalating debt there as well. What's going to be the recovery profile, if you like, for the West?
Yeah, it's interesting because the entire debate these days is whether it's going to be a V-shaped or W-shaped. I've even heard of the Nike logo shaped.
Swoosh, yeah.
Which is fascinating. The most likely scenario is an L-shaped recovery. In fact, if we look at the last 30 years, more or less, the shape of recoveries tends to look a lot like L-shaped recoveries in most cases. We get out of crisis with more debt, less productivity growth, less wage growth, and lower unemployment growth. It recovers, but it's quite subdued. I think that is it's quite typical, and I would say that it's almost impossible that the recovery sees any different shape than that, because the measures that are being taken also accommodate to that L-shaped recovery. It's literally the reason why governments are happy to take that massive amount of debt, is because they believe that we're going to continue to see very poor inflation, and we're going to continue to see a very, very poor headline inflation, and we're going to continue to see a modest environment of growth. Therefore, they will continue to absorb the savings of the saving nations.
So, well, it's a bit depressing, though, isn't it? But do you think, though, that then the countries that emerge and start to see growth and take advantage of the situation are the ones that really have to return to fundamentals?
Oh, completely. It's going to be as simple and as complicated as this. It is going to be the ones that have actually implemented less stimulus packages and less aggressive policies to quickly address the pandemic, or to use the excuse of the pandemic to massively increase government spending, the ones that get out faster and better. And the more dynamic economies, that see the benefits of separating themselves from the very large giants that are going to continue to see a perverse incentive to Japanize the economy, which is, for example, what the Eurozone is doing, will actually benefit. So obviously, when I'm talking about growth, I'm talking about global growth, weak global growth with a poor headline inflation and high debt. However, within that sort of global picture, there'll be many economies that taking advantage of being both a global and open, and at the same time local and more prudent with monetary and fiscal policy, they will be able to take advantage of that improvement in a much better way. Absolutely, they will.
What would your final words of advice be to tech entrepreneurs that have an interesting product and want to get it to market? Should they kind of give up and go home, or should they relocate to certain markets, or what should they maybe consider bootstrapping, or what's the best piece of advice you would give to those who are watching, who are on the verge of launching the next new thing?
Well, I think that it's going to be a critical time for many economies that have plenty of cash and large sums of capital to diversify their economy. No, emerging economies in the energy that depend a lot on energy, for example, etc. So I think that it is going to be a time not to decide to put the brakes and wait for things to get better. I think it's a time to go out right now and convince those investors that have too much exposure to real estate, too much exposure to energy, too much exposure to very typical traditional sectors, that they need to put an important part of their capital into technology and into innovation, because that is what's going to help them navigate this crisis. And that is something that can actually be put in the economy in a way that can generate an important improvement in terms of employment and in terms of diversification of the economy very quickly. And that is a critical thing. A lot of governments are right now worried that their economy in each of the countries that they're living in is too exposed to one single sector, one single area. So go for those and try to get that product or that idea forward, because diversification is going to be critical.
Daniel, as always, you're a breath of fresh air and common sense and articulate understanding of economics. I very much appreciate your joining us, and thank you very much indeed for hopping onto this call from Madrid. What temperature is it there today, by the way? Is it nice and warm?
Thank you very much. It is absolutely boiling out there. It's almost.
It's not here. Thanks a lot, Daniel.
It's about 95 degrees. Right? And it doesn't, and it's also very, very dry. So anyway, it's much better to be here in a conference room with a bit of air conditioning and talking about the future of the economy.
Thanks a lot, Daniel.
Thank you very much.